Welcome to Sophie Daddy's channel. Today, we're going to break down a really powerful option strategy that the pros use all the time, the vertical credit spread. Seriously, by the end of this, you'll get what it is, how it works, and how it can help you trade with a heck of a lot more confidence and way less risk.
So let me ask you something. What if you could get paid right now today just for making a bet on where a stock won't go? I mean, that sounds pretty amazing, doesn't it? But as you can see here, there is a razor's edge between doing this the smart way and taking on a crazy, catastrophic amount of risk. And that is exactly where this strategy comes into play. I want you to think of a credit spread as your safety net. It's specifically designed to let you collect that income we talked about while totally protecting you from that nightmare scenario.
So what is this thing exactly? Well, a vertical credit spread is basically a two-part trade. You sell one option, which brings in cash, but, and this is the important part, at the exact same time you buy another cheaper option. The key phrase here is defined risk position. From the second you put on this trade, you know the absolute most you can possibly make and the absolute most you can possibly lose. No surprises ever.
Let's look at how that safety net is built. First, you sell an option. This is your income engine. It's what puts that premium, that cash, right into your account. But here's the brilliant part. You take a little piece of that cash and you immediately buy a second option that's further away from the stock's price. This second option isn't really for profit. It's your insurance policy. It puts a hard, unbreakable ceiling on any potential loss. And you know what's so cool about this structure? It's incredibly flexible. You're not just stuck betting on a stock going up. You can use this whether you think a stock is going up, down, or even if you think it's just going to go sideways and do nothing at all. Okay, so you've got two main flavors here, and it all depends on what you think the market's going to do. If you're feeling bullish, or even just neutral, meaning you think the stock will go up or stay flat, you'd use a bull-put spread. Your only goal is for the stock price to stay above a certain price. Simple. On the other hand, if you're bearish, you'd use a bear-call spread. Here, you're betting the stock will stay below a certain price. Either way, you win if the stock just avoids one little area. All right, now we get to the real heart of it. To truly understand why option spreads are so powerful, you have to see them compared to the alternative, the risky thing a lot of beginners try. This is the showdown. On one side, you've got selling a naked option. This is the Wild West. It comes with undefined, and I mean potentially catastrophic risk. Plus, it takes a ton of capital just to place the trade. But on the other side, you have the credit spread. The risk is absolutely defined and limited from the start, and it requires just a tiny fraction of the capital. It's really the difference between pure gambling and running a calculated business. And you can see it right here in the numbers. Look at the max loss for a naked put. Substantial. That literally means the stock could go to zero and you'd be on the hook for all of it. Now look at the bull put spread. Limited and defined. This has a huge impact on your money. The margin, the cash you have to set aside, is super high for the naked option, but for the spread, it's low, and it's exactly equal to your maximum defined loss. That's what we call incredible capital efficiency.
Okay, so we know spreads are safer, they're more efficient, but how do the pros get a real statistical edge? Well, it all comes down to one crucial thing in the market. You can think of it as the secret ingredient. And there it is, implied volatility, or IV. The easiest way to think about IV is as the stock market's fear gauge. When fear is high, IV goes up, and that means the price of options, the price of insurance, gets really expensive. As a credit spread seller, you are selling insurance, so you want to sell it when it's most expensive, right? You get paid more for taking the exact same amount of risk, all because the market is nervous.
So why is this so powerful? Well, there are three big reasons. 1, you just collect more cash for the same risk. Easy. 2, high volatility almost never lasts. When it inevitably falls back to normal, we call that a volatility crush. That drop in price is a direct profit to you, no matter what the stock does. And 3, high IV statistically overstates the real danger. The market is essentially overpaying you to take on a smart, calculated risk. It's an amazing edge.
So we've covered the what and the why. Now let's get to the how. Let's turn this into a real actionable playbook. You see, the pros don't just guess. They follow a clear set of rules for managing these trades from the moment they get in to the moment they get out.
First up, when to get in.
The sweet spot is right around 45 days before the options expire. Why? Well, it's because of something called time decay. It's just a fancy term for the fact that options lose value every single day. And right around that 45-day mark, that decay starts to speed up really fast. As an options seller, that's exactly what you want. Time is literally on your side.
Next, when do you take your profits? This is all about discipline. The goal is not to hang on forever and try to squeeze every last penny out of the trade. The professional rule is simple. Once you've made 50% of the maximum possible profit, you close the trade, take your money, and move on. This dramatically increases your win rate and frees up your capital for the next opportunity. But what if it hasn't hit your profit target yet? Well, when you get down to 21 days left, it's decision time. If the trade is at a loss, you can try to roll it. That just means closing your current trade and opening a similar one for the next month, giving yourself more time to be right. The key is to do it for a credit, meaning you get paid to make the switch. If you're near break-even, just close it. Get out and find a better trade.
Okay, we've covered how to get in, how to manage the trade, and when to take profits. But there is one final, absolutely critical thing you have to know about. There's a hidden trap at the very end that can completely destroy all the safety we've so carefully built into this strategy. And this danger has a name. It's called pin risk. And trust me, it is the #1 threat to a credit spread trader who gets lazy or careless right at the finish line. So what on earth is it? Pin risk happens if, on that final day, the stock closes right in between your two option strike prices. What happens is your insurance option expires completely worthless, but the option you sold gets assigned, meaning you're suddenly forced to buy or sell 100 shares of stock. All of a sudden, your perfectly safe, defined risk trade has morphed into a huge, undefined stock position that you were stuck with all weekend. It is a disaster. So how do you avoid this nightmare? Thankfully, the solution is incredibly simple, and it is non-negotiable. This is the golden rule. You always close your spread before the market closes on expiration day. Don't even think about it. The few dollars in commission it costs is the cheapest insurance you will ever buy. Which really brings us to the final crucial point. When you use a strategy like the vertical credit spread, with its rules for volatility, for management, for risk, it forces you to answer this one question. Are you choosing to build a real trading business, or are you just buying lottery tickets and hoping to get lucky? It's your choice.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.